Hey guys, this is Joe, founder and host of Startuprad.io. As you guys may already know, I've run this podcast full time since January 2021. I'm very happy to announce that Anchor FM is my sponsor for this podcast. If you haven't heard about Anchor, it's the easiest way to make a podcast. Let me explain. It's free and it's easy to use, even for a newbie. They're creation tools that allow you to record and edit your podcast right from your phone or computer. Anchor will distribute your podcast for you so it can be heard on Spotify, Apple Podcasts, and many more. You can make money from your podcast with no minimum listenership. It's everything you need to make a podcast in one place. Download the free Anchor app or go to anchor.fm to get started.
Welcome to Startuprad.io, your podcast and YouTube blog covering the German startup scene with news, interviews, and live events.
Welcome everybody, this is Joe from Startuprad.io. Just a little take here. Unfortunately, we did experience some technical glitches and the video quality from Yoram, my interview partner from the interview right now, was pretty amazing. I always saw him straight here in HD quality, and actually sometime when you're watching this video interview, you can see his mirroring video feed here in the back in the glass door. But for whatever reason, it was just not recorded, so I had to replace the picture of me listening to him with the static picture. I hope you can forgive me, and we do our best that this does not happen again. Enjoy, thank you very much. Hello and welcome everybody. This is Joe from Startuprad.io, your startup podcast and YouTube blog from Germany. As you can see, I'm still in my cramped study. And I do have a guest here from Berlin. Hey, Yoram, how you doing?
Hey, how are you?
I'm doing great, thank you. And as we already established, I had a clown for breakfast, so meaning I'm feeling very good this morning. And we are here to talk first about you, then the company you co-founded, Dealroom, and then just a tiny bit the numbers you are actually collecting here on the German startup scene. So let's hit the road. I've seen you've been an investment banker. Ooh, bad in the past, right?
Yes, that's right. At Lehman Brothers, of all.
Well, actually, I gotta tell everybody says, oh, Lehman Brothers, bad. I've actually also been in a company that was at one time in insolvency. And the thing is, not all people there are bad. Even usually the majority are very good and decent people, but there have been some bad decisions made that actually lead the company in insolvency. So can you tell us just a little bit about your work there, your time there, and what brought you to Dealroom, just to skip the insolvency and the financial crisis?
Yeah, no, sure. But so Lehman Brothers was my first job after university. University I went to in Amsterdam, and then I joined Lehman, and I was part of the mergers and acquisitions team. And we were working like non-stop, crazy hours, helping corporates with giving them advice about mergers and IPOs.
For everybody who's not from the financial services area, M&A guys are those who work till like 2 a.m. in the morning, then go for an hour workout, maybe take a shower and then work again. They don't need sleep, right?
I definitely was like a zombie at this time, and actually going home at 2 was kind of early, believe it or not. I was always exhausted, but it was fun. We had also no idea what was going on the trading floor and all this stuff with securitization. I didn't even know what that was. And I was really surprised when Lehman Brothers went bankrupt, because I was completely buying into all the internal propaganda that everything was great. So it was a total shock to me. So I was pretty naive, I guess. And I remember then at some point there was one weekend when it was all over the newspaper that was really over. And on Monday morning, we were all called into one huge auditorium with, I don't know, like 2,000 people or something. And it was, I think, the Deloitte or PricewaterhouseCoopers, one of those firms who took over and say, we're now in charge. You're not getting paid at the end of this month. And good luck, basically.
Ooh, how did you feel there?
Yeah, it was kind of exciting because I was still young and I didn't have a mortgage, no family. So I could kind of laugh it off, but I could see that for some people, they got really, really nervous. And in the end, most people, they turned out fine. I mean, they got other jobs. Our team was acquired by another bank. So everyone kind of landed on their feet. Maybe not everyone, but 99%.
Well, good to hear. And then you got acquired by another bank, and then at one point you decided, okay, enough zombie mode. I want to have a private life or something.
So then the next 4 years, I joined a German colleague of mine, Marco Rodzinek. He's set up NOAA Advisors on his own. Then I joined him as the number 2. And so we did that for 4 years. We did also mergers and acquisitions for small internet companies, like selling internet companies to private equity or to a bigger competitor. And that's how I kind of got more into the internet and tech world. So I did that for 4 years. During all that time, I was always working with lots of databases to do our work. They were mostly American databases, and I found them to be really incomplete and not covering Europe very well. So that's how we got the idea.
We may just a little bit interrupt here. Very sorry about that, because most people don't understand why you need databases. And my professor from company evaluation always told me to evaluate a company is to compare a company. So you have to dig through many, many databases to actually come up with a valuation, how a company should be valued, approximation. It's always like, something like this, but you have to get a basis for your guesses. Like when a company is comprised of several businesses, you have to evaluate them very differently. Can you go just a tiny bit into that without getting too technical?
Yeah, so there are lots of day-to-day use cases for needing a database. One, for example, let's say you're an advisor and you're advising a startup on who to raise money from. Normally, you would then go through your own Rolodex, ask around people you've recently spoken with, kind of informal. But instead of that, you could also have a database that automatically tells you, okay, for this type of round, you need these and these investors, or these and these buyers potentially are interested in acquiring this company. Another use case could be that you're having a presentation, even as a founder, maybe you're building a pitch, or as an advisor, you're making a pitch to someone else. You want to give an overview of who are the major players in an industry. Let's say you're advising Delivery Hero, and you want to show them who are the major players and investors in the Middle East and in Latin America in online food delivery. Then you need some kind of database to quickly give you those answers. And then thirdly, like you said, valuation can be a reason. So you want to know what kind of transactions have happened and at what valuation, and what kind of multiples were being used, so that you can compare someone else's valuation to your own, which is a little bit like with housing. You look at the price per square meter. And with companies, you look at the price per amount of dollars revenue or EBITDA or earnings.
It's so-called multiples, right?
Yes, valuation multiples.
For example, they're very, very different things. For example, some companies are just valuated by the cash flow. It's called discounted cash flow. Some are valued as options. So basically, it's the prices that drive, for example, all innovative businesses like biotech, very high valuations. And for some, it's like the multiples, like one client is worth X.
Yeah, exactly. So yeah, it depends a bit on the case. Like exactly like you said, biotech or also in venture capital, you can look at it as an option. If a company is traded like Google or Apple, Amazon, they're usually valued more or less on a valuation multiple. And if a company is completely private and there are no real comparables, then you look at the DCF valuation, discounted cash flow, which is what people in university still learn, but it's actually not used that often, I think.
Admittedly, I learned it, and for everybody who just understood some type of Chinese, go down here in the show notes. We'll have link for everything he explained there. And you guys have some links in dealroom.co as well, like a little tutorial, little database explanations on that.
Maybe not as much as we should. We try to keep it all self-explanatory, but we're working on that. We should make some video demos soon.
Mm-hmm. Great. And that's basically why you need a database. And then you came up with the idea, hey, they're all American based, which usually means you have very decent data for everything in North America, especially the US. Usually the quality in Canada and the UK is also quite good. And then there's Mexico and rest of Europe, where it usually gets pretty patchy in countries that don't speak English, like Germany, I remember France, Spain, Italy, or something. That's where you start having troubles, like to find comparable companies or to find data at all.
Yeah. What we really focus on is discovering promising companies, and it can be from a pre-seed, seed stage, all the way to unicorns. So most databases are very factual, kind of backward looking. We try to kind of look more a bit forward, kind of predicting where is the next company. Not we don't predict success, but at least we can predict which companies you should keep an eye on. And then it's up to our clients to do that, and they can use our software to track these companies, and also we make it a bit easier for them to get in touch with them.
And do you actually charge on a subscription basis or per deal?
A subscription basis. So it's all flat fee. We have even a free version that's more meant for founders and smaller angels and VCs, employees of tech companies. So they can use a free version of Dealroom. It has
I use it.
Great. It has some limitations in the number of results, and you cannot export data. But it gives you still a lot of room to explore. Then we have a paid version that's mostly used by VCs and large corporates, companies from all over the world, like McKinsey, Google, Amazon, Sony, Bayer, Unilever. They're all obsessed, and they should be, with innovation and understanding where the world is going. And so tools like ours are critical for them to not get lost and not get behind.
And the first thought that popped into my mind, we have a lot of founders who are actually watching those videos. And the first thing that would be in my mind as a founder, how do I get into your database? How do I do that?
Okay, that's really easy. You just go to dealroom.co, you sign up, and you will get prompted by itself to create your own company. Might be that it's already in our database, and then you can claim it. You just need to show that your business email matches the URL of the company in the database. if there's, if it doesn't and you're still really sure that it's your company, you can just write us in the bottom right of the screen. There's a customer communication tool and we will figure it out.
I see. Pretty cool. And basically, we just wanted to touch just a tiny bit on examples you have been publishing. Because my interest with you guys started with the monthly European Venture Capital Report of February 2018, which was published a few days ago, March 12th, 2019. And we might tell the people that it's very normal to have data published very late. For example, here in Germany, there's a law. If you do have a certain size as a company, you have to publish a very light version of your balance sheet. And right now, we are in March 2019, and right now, companies are publishing 2017 numbers. So it's not uncommon to have a time lag of sometimes even years in publication numbers, right?
Yeah, no, that's right. But for this February report, for example, we focus on investment data, and that's generally reported straight away, except for really early stage rounds. There can be a large delay. But for the larger rounds, nowadays they're usually reported immediately, and it's self-reported. They're not even obliged to do it, but it's a kind of signaling by startups to show, like, hey, look at us, we raised a lot of money, come work for us, look at our product.
I see. Actually, you're going exactly the right direction, because with my project Rhein-Main VC, even here in the Frankfurt Rhein-Main area, we do have big trouble getting numbers just for business angel investments like pre-seed, seed, sometimes even Series A. We talk to startups and they raise 7 digits and they're not even writing a press release. So sometimes it's really, really hard to combine those numbers. And you're actually relying on the publication. So there's a little skew toward companies who are publishing their numbers.
Absolutely. And I think that you're right that especially Germany is a bit more restrained, conservative with publishing numbers, especially in angel rounds and family and friends funding rounds are often not reported.
Also, family offices I found are extremely secretive.
Okay, well, that could really I wouldn't be surprised if that's the case. So the numbers are incomplete, and we're really working to try to bridge that gap. I think that in the UK, France, there is less of that. Of course, some rounds also don't get reported there, but it's a smaller proportion.
I see. It's incomplete, but it's better than to have nothing. So every number you get anywhere, except it'll be from like some authority where companies are obliged by law to report, or some regulation. Basically, you always have to work with incomplete numbers, right?
Yeah, I mean, I guess the answer is yes, even though we don't like it. It's just the way it is. But we try to be open also with that, and make an effort to get as much data as possible. So, for example, we recently last week launched a free database in Berlin to really give this investment grade database for free to Berlin tech community. And our experience is that in return, we can expect to receive more data also, because it's free. There's a higher incentive for people to make sure they're noticed and that they're on there with accurate information. And we've done that also in Amsterdam 4 years ago, and 15 other cities since, and that helps us really to improve the data by quite a lot.
What I found interesting when I skipped through your report, we're not going into details, but the usual answer, go down here in the show notes and you'll find the link to the report, of course. Um, what I found interesting is at first they are signs that that this year 2019 maybe, like it's February, there's a maybe, should be, maybe better than even 2018 was. And actually, there's a tendency to always do like larger rounds, and the large rounds, they have a disproportional impact on all the statistics, right?
Absolutely. Yeah, that's true. So yeah, so far this year has been 50% higher than the same time last year, which is insane because last year and the year before were also records by a large margin. But yeah, it's large. It's driven by a few very large rounds. That some people would say, oh, that's not even venture capital anymore. So there are a lot of things happening here at the same time. You see that, yeah, where venture capital ends and let's say private equity begins and the public market begins, those lines are really blurring. And that's a trend that's already also happened in the US and in Asia, and is also happening in Europe. So the time until when a company goes to the public market, for example, is kept being delayed. And so by necessity, let's say, venture capital needs to invest larger amounts as the company is getting bigger. And I think maybe in the old days, let's say 20, 30 years ago, these huge projects would be financed by corporates like Shell and big, BASF, and these kind of chemical companies. They also would make huge investments into new projects that maybe didn't go profitable for 10 years. But now the world is changing. It's moving faster, and you need startups to kind of jump on these opportunities. And so you can see now these large amounts are getting invested by VC, by venture capital. And the other day I saw someone noting that also if you look where venture capital is coming from, it's coming from pension funds. They're still allocating only a tiny portion of their funds into venture capital, and there's still a lot more room there. So,
and we may also tell the people, we know we have like 80% professional audience, but the rest of the 20% should learn something when they're watching this video. And actually, we should tell them it used to be the case, like also in the regulation, that the venture capital funds invest in small startup companies, tech companies. And the private equity funds most of the time been there using leverage, meaning loans, to buy out companies. They are also called buyout funds. But now VCs are investing in older and older companies, and also sometimes private equity funds are actually investing in companies before they even go public. So there's a really blurring line of everything.
Exactly. So that's what we're seeing, and that's what's driving these larger and larger numbers. So on the one hand, you think, can this go on? Is there a bubble? We are also, when we write reports, we try not to say, oh, this was a fantastic year, this was a better year than last year. I think time will have to tell if this was in fact better or not. maybe from hindsight, in 5 years, we will say, well, this was crazy, and the correction was needed. Of course, some deals will turn out to be good. Some deals for sure will turn out to have been really bad. My perspective on it is that the market overall is still pretty disciplined, with lots of exceptions, but it's not like the kind of the internet bubble of 99. Perfect example is Lyft. So it's really, or even Delivery Hero, for example. It's very easy to be cynical about these companies because often they're still making losses. But if you then really look into the economics of the business, you see that there is a profitable business brewing underneath, and they have a really clear path to profitability, but they're just investing in growth. So my perspective on it is that overall the market, you're seeing some strange deals and sometimes too much money going into too small companies, and there is maybe too much money here and there. But overall, the market to me seems actually to know very well what it's doing.
Well, for me personal, amazing closing words.
Okay.
And everybody who would like to learn more about you and Deal Room can go down here in the show notes. We link your LinkedIn profile as well as the company website, as well as the February 2019 monthly European venture capital report we just discussed, right?
Yes, exactly. Blog.dealroom.co has most of our reports, and they're all free. And if you have any questions about them, feel free to reach out to us.
Great. Amazing. Thank you very much.
Perfect. Thank you very much.
That's all, folks. Find more news, streams, events, and interviews at www.startuprad.io. Remember, sharing is caring.